This is your LMAX Exchange technical update for Wednesday, March 29th, 2017. Euro dollar. So right now it's looking like that bullish breakout that we saw in the euro on Monday above critical resistance at 108.75 is possibly a false break, with the market unable to establish above 108.75 as we had warned. We talked about the need for the market to establish a close above 108.75 at a minimum to confirm the bullish breakout and potentially open the door for significant upside ahead. Now that picture is still alive, but if the market breaks back below some recent support around 107, that would take the immediate pressure off the top side and get the market thinking about potentially a negation of this basing pattern and a resumption of the broader downtrend for a retest all the way back down towards the 2017 low at 103.40. So right now we're watching the market stall out ahead of that key resistance, or after breaking above but failing to establish above that key resistance at 108.75. Over the coming session now, the key levels to watch above and below are 107 below and 108.75 above. Sterling dollar. So cable had come back up into a critical resistance zone in the 125 to 126 area, but was unable to sustain those gains as we had anticipated, with the market adhering to the broader downtrend and once again rolling over. At this point, deeper setbacks should not be ruled out, with a break back below some key support right now on a short-term basis, which comes in around 123.24. That's the low from the 17th of March to strengthen this outlook and accelerate declines back down towards the 2017 low at 1987, which guards against the plus 30-year low from October of 2016 at 1840. If we do see any rallies, they should continue to be very well capped, with only a break back above the December 2016 peak at 27.75 to negate the downtrend. Dollar yen. So despite a little bit of a bounce in dollar yen in recent trade after the market stalled out just shy of 110, any rally should continue to be very well capped following that significant breakdown that we saw below some multi-week range support at 1160. At this point, the breakdown below 111.60 does open the door for the possibility of a fresh measured move downside extension of 400 points towards 107.60 over the coming days. Only back above recent highs that we saw around 111.80, a close above that level, would take the immediate pressure off the downside. Euro Swiss. So Euro Swiss has been confined to a very well-defined downtrend, but it's been a slow go here. The market ultimately is favored to continue to be very well capped into rallies with lower tops and lower lows seen, and this most recent high at 108.26 acting as the most recent lower top, anticipated lower top, which will be confirmed on a break below the 2016 low at 106.24. The market has had a hard time breaking down below that level, but still the downtrend remains intact, and a break below that level will expose a fresh downside extension towards the 104 area further down. Only back above 108.26 would delay the bearish outlook for Euro Swiss. Aussie dollar. So Aussie has been very well capped into rallies, once again up towards the 78 area. This is a level where the market has been very well capped over the past several months, and so the market is expected to once again roll over here with a breakdown back below the recent support that we saw at 74.92 going back to the 9th of March. A break below that level will strengthen the outlook and accelerate declines potentially down towards the 70 barrier. Any rally should be very well capped, with only a break back above this recent 2017 high at 77.50 to question the outlook. Dollar CAD. So dollar CAD has overall been very well supported on dips. The trend here has been favoring the top side, and so this latest setback that we've seen towards 132.64 should be supported in favor of a higher low ahead of the next major upside extension beyond recent resistance in the form of that multi-day peak at 135.99, a break above which exposes the 140 area further up. If we do see setbacks below 132.64, they should continue to be supported down towards 132, with only a break back below 129.69, that low that we saw on the 31st of January, that 2017 low, to negate the bullish structure. Kiwi dollar. So Kiwi continues to be very well capped on rallies. This is a market that's also showing signs of topping out in 2016 after putting in a highs just shy of 75 in 2016, and then into 2017 stalling shy of 74. And so the pressure is on the downside, and the market is expected to trade back down below some medium-term support in the form of that 68.62 low that we saw back in December of 2016. A break below that level will open the next major downside extension towards 65. Any rallies that we see here should ideally continue to be very well capped ahead of 72. SPX 500. The S&P 500 is bouncing a little bit after this latest pullback that extended down towards the 2320 area, but overall, this market is still looking like it could be in the process of topping out, and a lower top will be sought out over the coming sessions in favor of that next major downside extension below 2320 and down towards support in the 2300 area. If the market establishes back above 2380 on a close basis, that would compromise this outlook for a potential top here and put the pressure back on the top side. But until then, there is risk that this rally that we're seeing right now will stall out in favor of a lower top and fresh downside extension back below the recent low that we saw this week, just shy of 2320. Gold. So gold is a constructive chart this market has been basing out since 2016 after stalling just shy of 1100, putting in a series now of higher lows and higher highs. And so the latest pullback that we saw just under 1200 should be supported and will be confirmed as a fresh upside extension on a break above 1265, which will open the door for a move well back above 1300 and towards the 1330 area. At this point, only a back below 1180 would compromise the constructive outlook, with gains ultimately seen back towards the 2016 peak at 1375.